given you were talking about your equity orientation bias, and given what's going on right now with the stock market, just what your views are, whether or not the stock market is currently expensive, and whether or not you have any money in tech stocks with all the valuations and IPOs that have been going on in that space. What do you think about that? And also, what would you do in terms of investing in response to what your views?
So one of the great things about having a diversified portfolio is that you can worry less about the relative level of valuation of the various assets in which you invest. So if you go back to the mid 80s and you've got a portfolio that's 50% in domestic stocks, you have to worry a lot about the valuation of that portfolio because half of your assets are in that single asset class. But if you've got a well-diversified portfolio with, let's say, minimum allocation of 5 to 10% and a maximum allocation of 25 to 30% in an individual asset class, the relative valuation of each of those asset classes matters less. And there's another kind of nice aspect to a rebalancing policy. If you set up your targets and you faithfully adhere to those targets, suppose that domestic equities have poor relative performance. Well, then you're going to buy domestic equities to get them back up to target, selling whatever it is that had superior relative performance to fund those purchases, and vice versa. If domestic equities have great relative performance, you'll be selling to get back to your long-term target and buying other assets that have shown poor relative performance. So if you're in a circumstance where domestic stocks are expensive, well, you're selling into this superior relative performance that the domestic equities are exhibiting, thereby maintaining your risk exposure at a level that's consistent with what's implicit in your policy asset allocation. So that's kind of a long way of saying that if somebody asks me whether stocks are expensive or cheap, my first line of defense, it doesn't really matter all that much to me because we're well diversified and because we do a great job of rebalancing. But the reality is that those questions are just incredibly tough to answer. If they were easier to answer, I guess I'd be much more excited about market timing as a way to generate returns. In terms of the second question with respect to technology, Yale's had a long-standing commitment to venture capital, and over the decades, it's produced extraordinary returns for the university. And we continue to have a world-class group of venture capitalists. We've got exposure to companies like LinkedIn and Facebook and Groupon, and I hope that this wave of IPOs that people are writing about in the press actually occurs, because that would be very good for the university's portfolio. It's been a long time, right? I mean, we benefited enormously in the internet bubble in the late 90s, and the last decade's been a bit fallow. And we also find on the marketable security side that technology stocks tend to be less efficiently priced than many other securities, and so we have a manager that is heavily focused on information technology stocks, and another manager that's very heavily focused on biotechnology stocks, and both those managers have produced very handsome absolute and relative returns, and that's an important part of our domestic equity strategy.